I would suggest that the three panelists introduce themselves, a quick overview of what they do. A minute or so, just say who you are, and then we'll get into it. And Mark, go ahead.
Sure. Am I in the right spot right now?
I think you're right. Yeah.
If Marty wasn't telling you to move, then you're in the right spot.
Okay.
Everybody is great. We can't see Howard.
That's okay.
Okay.
How's audio?
Thanks for TV.
Mic checks.
My name is Mark Norbury. It's a pleasure to meet everyone today. I'm a founding partner at Scenic. What Scenic does is direct venture secondaries. And we have a broker-dealer side of our business where we are representing sellers and bringing them to the institutional market. We also have a fund which invests in that same underlying asset class, which is buying shares of venture-backed companies that are very close to exit, 12 to 36 months from exit. And we have a 4-year fund life with a diversified portfolio of 35 to 50 positions.
Fix.
No, Ricky.
Hi, everyone. My name is Ricky Tejapaibul. I'm managing partner of Wildcatters. So we're a venture capital fund. We were founded back in 2009 as one of the first new accelerator programs in the world. So we invest in early stage companies, and we're from pre-seed, seed up to Series A. We're an active investor, meaning that not only do we provide capital, but how do we connect entrepreneurs with mentors, with advisors? Because the way we see is that the founders, they're experts in what they do, but none of us are experts in everything. So how do we surround themselves with people who can help them navigate through the challenges that they're facing? And we invest mostly in the B2B, B2B2C side. So scalable businesses could be software, cloud-based companies, could be sustainability or even lifestyle companies like sports, esports. And about 80% of our investments are the US, 20% outside the US. Actually just got back from the Middle East last week. There's a lot going on over that part of the world. Well, here we're talking about the economy slowing down, but a lot going on.
Stealing my questions.
So good afternoon, everyone. I'm the host. So I spoke earlier today, but my name is Peter Thurlow. I've been a patent attorney for about 25 years. So I was an engineer to start. I got involved in the family office space around 7 years ago when all the startups and smaller companies needed capital. Started hosting the meetings. Initially, the meetings, I was just introducing the founders to the family offices. But after you hold lots of these meetings and meet lots of investors, it became working with the family offices to introduce them to the startups to see certain deal flow. So we'll get more into it, but that's my background.
And my name is Howard Cohen. I'm an advisor with Strategies for Wealth, and primarily I work with business owners on their exit strategy, their business continuity planning, buy-sell agreements, executive benefits, etc. We also work on tax strategy, making sure that when clients do sell their business, that most of the money or as much money as possible stays where they want it, which is in their pockets, and not going to the uncle in Washington. Mark, you mentioned secondary businesses, the secondary market, excuse me. And can you just give us a quick overview of what the secondary market is? We really haven't talked about it much here before.
Yeah, so if you're comparing us, I'll make two comparisons. If you're comparing venture secondaries with traditional venture is buying shares from companies that are issuing new capital and for growth purposes. Venture secondaries, we're buying from existing shareholders of those businesses. Another theme within the secondary market are LP secondaries, where holders of LP interests in venture capital funds are looking to monetize those LP stakes. We don't do that. We're doing direct venture secondaries, and we're buying from those shareholders. The usual shareholders that we're buying from are founders, C-suite members, early investors. And motivation for why people want to sell is short-term liquidity needs. And especially in this market where IPOs haven't been happening, there's a lot of people that thought they were getting liquidity and maybe got into commitments that they're actually spending that liquidity before it came. And so what we're seeing in the market is just a record number of sellers that have come into this market for venture secondaries looking for sources of liquidity. And we are one of the few, surprisingly, there are very few people that do what we do, one of the few sources of liquidity that's specialized in investing in this asset class.
So if I can go back to the last presentation by Jessica, Dr. Grossman, what we try to do is we have lots of clients that are I chair the med device group and the healthcare area, and we'll connect the doctors to, first we always look at government funding, whether it's DARPA, NIH, National Science Foundation. We'll see about this new group tomorrow, the Office of Strategic Capital, and try to make connections. I think my real title these days is making connections between the founders and the capital, because you can't, as I say, obviously, you can't have capital, you can't have a company without capital. A couple of examples of that, this On-Demand Pharmaceuticals, the company with Dr. Lang, he's speaking. He's raising money, so we've introduced him to a bunch of teams. And we'll handle all the legal work associated with that. That's the IP, the corporate, and the VC. Other companies, I just wrote down a list. As I mentioned earlier today, one company gets $160 million. I know this is more of a venture capital, maybe more typical what Ricky does, but we're kind of venture capital for the family offices, for those of you that work specifically with them, where we'll provide the deal flow, match them up, and handle all the IP. So in one deal, a family office has raised, they have $40 million. They're going to buy a bunch of IP out of university in New York. We'll manage all that. And then other group just came to us and managed they have $160 million that they're going to invest in the company doing vertical farming. And then I was in the military, so I work as an advisor to DARPA. So I think it was Blake on the last panel that spoke. We try to work with DARPA companies. One of the companies you're going to hear about tomorrow, and Dr. Ling is going to come by this afternoon, and DARPA is going to be here this afternoon as well, is that company received $82 million in funding to de-risk their technology. So in their technology, they're actually making generic drugs. Right now, it's kind of a trailer concept where all of the equipment and proprietary technology is going to be inside of a trailer. Those of you that are familiar with 3D printer technology, in the future, the idea is to make more of a modular setup that's going to be in someone's home, that they print the generic drugs that you need. Mark Cuban, others are involved in the space. Amazon is involved in the space. It's a multi-billion-dollar market, and you'll hear more about that. But so I'm the facilitator, the connector, and I get to see a lot of capital and deal flow.
So, Ricky, one of the things that we were talking about is how deals have plummeted here in the United States, and you have a different take on what's going on in the Middle East.
But yes, so when we hear in the news a lot more from mainstream Western media about what's happening in North America or in Europe, the economy is slowing down, but there's still another part of the world that things haven't slowed down a bit. So I was just out in the Middle East, in Dubai and Saudi Arabia, and that part of the world, it's just there's already capital within the region from energy, oil and gas, and also capital inflow coming into the region. So with that, also combined with in terms of technology innovation, it's a region that's still been lagging behind, both behind the US, Europe, or even Southeast Asia. So with that, there's a lot of opportunities, and it's something that as an investor, as a holistic investor, we look at from a global portfolio, it's something that should not be neglected.
So what's the difference between the investments that you see here in the United States and in the Middle East?
So I think from an investment standpoint, so some of them are, so in venture capital, some of them are R&D driven, that it's something that could be cutting edge, deep tech, cutting edge innovation that's applicable to anywhere in the world, while certain things are more of region specific business models. And a lot of times there's models that could work in one part of the world and then it'd be adapted to another part of the world. So some of those you have to look at more of a micro market and to see what's the market size and what's the demand. But what we like is what can we bring from one part of the world and help enter the market in another part of the world.
And just to follow up on that, we have a couple of deals. There's a lot of sovereign wealth funds around the world. One country we're dealing with is Qatar. I sometimes hear Qatar or Qatar. I'm not really sure how to pronounce it, but it's go by Qatar. And they have a $600 billion sovereign wealth fund. Saudi Arabia, obviously, lots and lots of money, and fascinating. Singapore, other countries. We're focused on Qatar right now, but there's a lot of money, even I think in Norway and around the world. There's a lot with the sovereign wealth funds.
Mark, do you get involved at all in the foreign markets?
Yeah, so our investors, we have a broadly distributed geographic group of investors. So we have just over half of our investors are Americans, and we have single and multifamily offices, including some valued investors in this room. We have some wealth managers, alternative fund of funds, but also we're getting a lot of traction with international single and multifamily offices who are wanting to get exposure to very close to exit cash flow positive companies, which is the main bulk of what's in our portfolio. So we're getting a lot of traction in particular with European and Middle Eastern investors that are interested in this market for direct venture secondaries.
Are both of you focused only on IT, high tech segments, or are you Catholic about what you do into consumer, energy, healthcare, whatever? Where do you focus?
I think that the definition of venture has broadened dramatically over the last 5 to 10 years. And so whereas traditionally you'd think of technology, deep technology kind of companies, but now venture has expanded so much. We invest across the spectrum of what venture invested in 10 years ago. So we're basically picking the winners of the seed and A rounds that were invested in a decade ago. Our segments that we're focused on are enterprise, big data, space technology is a very interesting segment, and we have a portfolio company in satellite technology and also a rocket company, both of them very advanced cash flow positive businesses. We also do fintech and insurtech, EV and mobility, consumer and late stage health tech and life sciences businesses.
So like Mark put it well, that the definition of technology is so broad these days, because it could be tech adjacent, tech enabled. So for example, we have portfolio companies in procurement space. They're software AI driven to help procurement, which is an industry that's been going on for centuries, but still doing business with stack of paper, very inefficient. So things like that, it's not rocket science deep tech, but it's something that really moves the needle when you look at the efficiency that's added and saves money for the clients.
And not to speak for DARPA, but they spoke at the meeting in September. Obviously, the main focus is on all the high-level national security-like technology, the AI. Quantum computing is a major issue that other countries are putting a lot more money in than we are. But that's a main issue. Obviously, cybersecurity, national defense-related things. There is an ESG panel, I think, tomorrow, Marty. But
yes,
there is, even when DARPA spoke, the government's putting a lot of money into clean energy and clean tech. So I think the last panel discussed taking waste as we know it and make it into beneficial products, and then separately trying to treat all the plastic waste. There's a lot of money from that from the federal government and recent laws. So there's lots going on in clean energy and in the ESG space too.
I have a quick question. Peter, you mentioned some of the larger institutional names, but it seems like the institutions have been focusing on the larger, like the SoftBanks of the world, or the Sequoias, and are you seeing more movement downstream towards more mid-market or smaller VC by institutions? Because that has seemed to be traditionally less traction oriented. Whoever wants to address that.
So we were talking about the types of managers that are attracting capital.
Well, this was with respect to size of the funds, and it seemed like institutions were, either playing big or not playing at all.
So yeah, let me address that from the perspective of the secondary market. So I will surprise no one by telling people about some of the spectacular valuations that were printed in the 2020, 2021 market boom by some prominent investors who I will not name today, who were aiming for speed as opposed to careful diligence approaches. And it's our perspective that some of those bad investing choices in terms of striking valuations were driven by funds that were just too big. When you have a fund that is in the multi-billion-dollar range, that it's not that they can't be effective, but you end up with minimum deal sizes where if you're not deploying 50, 100, $200 million at a time, then it's not economical to run that business model. And so you end up with people pushing money out faster than they really should have done. I think we're certainly big proponents of old-fashioned fundamental due diligence. Is this business going to work? Is the market accepting the products and services? Can they build their product and service profitably? Cash flow. These are the questions that we have to come back to. And being a smaller fund, we're a $250 million fund. We're building a portfolio of 50 positions, average position size $5 million. That means we're being very careful in deploying those funds into businesses at some of the lowest valuations that we've seen in a decade. Because of the market conditions that we were talking about, up until last year, you would see companies with revenues in the hundreds of millions, cash flow positive, commanding valuations at 50, 100 times next 12-month sales, which was crazy. We're now buying in at 3, 4, 5 times next 12-month sales, significantly below the valuation multiples that we're seeing for mature, slower growth public markets businesses.
So related to that, I mean, we all know that there was a bubble and now it's over, and the multiples you just cited are what are reflected in the public markets, at least among SaaS names, related areas. I'm wondering though, even given the reset we've seen, when you do a secondary transaction, are you doing that at a discount to what the fair market value of the common would be? And then a second question is, since you're coming onto the cap table after the transaction, is that a barrier to you being able to do transactions? Maybe the boards have to be convinced to let founders sell the stock. How does that work?
Two very good questions, Kurt. So thank you for it. So that is, I think, one of the barriers to entry in our market, which is why there are relatively few players that are specialized in venture secondaries. Getting your transactions approved by the company boards, navigating the waiver of broker rights. So a lot of people can go broker a deal around, but if you can't get the deal approved at the end of the day, then you've wasted your time. We've been doing this for over a decade. We've done more volume than pretty much anyone else in the world. It's a lot about personal relationships with board members, C-suite people, and there's a sort of venture world network that you're either part of or you're not, and we press that advantage. With regard to your question about discounts and valuation, yes, 100%. We are pretty much only buying at discounts. Over the last 10 years, the typical discount that you'd see in secondary as compared to primary rounds would usually be plus minus 10, 15%. What we are now seeing is discounts at 50, 60, 70% back from the most recent primary round valuations. And frankly speaking, a lot of those primary round valuations were at unsustainable levels.
What you just cited is consistent with the markdowns VCs are taking in their books.
Exactly. And so there's a lot of venture assets that haven't been marked to market yet. And if not to say anything bad about traditional venture, because it serves a valuable purpose in society. But where we are in the market cycle and where we are in the valuation opportunities, secondary is a way that you can capture this dramatic repricing that we're seeing that you can't capture in a traditional
it doesn't
primary
sound like,
strategy.
based on what you said, that you're actually transacting at a discount to fair market value. Clearly, you're at a discount to the last overpriced round, but not where they could raise money today.
No, we are consistently purchasing below even where the private secondary market is clearing. So we would argue that we are acquiring below even secondary, which itself is below primary, which itself is below public market comparables.
John, you have a
I
question?
can understand why your pricing models and your bargaining power is linked to public sentiment at this point.
Yes.
Because you're so late in the trajectory of these companies.
Yeah.
And their approach to the market. What I cannot understand is why, with deals that are perhaps your bailiwick, which are much earlier,
Yes.
and which would never get to the market, in terms of their product realization or their company development, say for the next 3 or 4, 5, 6 years, are also being discounted when you have intelligent investors sort of like being influenced by the sentiment of the marketplace, when they know that their realization is going to have nothing to do with it.
So it's getting discounted, but not as much. So if you look at the seed stage or the before Series A, the valuations have it was not as inflated in the last 12 to 24 months as a Series B, Series C, a growth stage. So that's on contrary to some belief that early stage investing is risky. Well, it's risky if you don't diversify your investments or if you don't have the skill. But if you have the skill, and more importantly, if you actively manage, actively give the founders the support other than capital, then you increase the odds of success dramatically, and you're not paying a huge premium subject to market volatility.
So are you finding that your price points are lower now, even so?
It is lower, it's less competitive, it's more of a buyer's market. But it's a market that's inefficient, I'd say less efficient. So there's a lot of skill involved in how do you identify the founders early on, and how do you build trust that the founders pick the right investors. It's not only about going for the largest check size, but what value that the investor can be long-term partner.
We've been coming to these meetings, at least John and I and others, for a while, where everything was about crypto. It seemed like every meeting for a while. The fact that it's not even being discussed is an indication that's not an area people are wisely not investing in. It's crypto.
I have a question, 2 questions about how you guys proceed.
But let me just,
I'm sorry.
Yeah, let me just finish. So, but you still, these days, the hottest thing is the AI. If you look at the Barron's newspaper from this past weekend, now they're all concerned about the AI. But there's a lot of money going into AI. Those valuations have not come down. So for the investors looking at that, only thing, the thing with that as well is even my kids showed me this chat GPT and the excitement around that. And they're saying that's only the first version. So those valuations are still up there and quite frankly, going to stay strong. And it's one of the big areas going forward. I don't think it's going to turn into a crap though, but I think it's the wave of the future.
You had a question?
Yes, I do. So last year I tried to get into a lot of and analyze, different brokers or, players and show me different investments in secondaries because I wanted to be active there. Primarily companies were like in later stage. And so I encountered a number of problems and I'm going to ask you how you proceed. One of them was they would offer us the shares of founders or some employees during the round. But was really hard to get access, being if you were a smaller player, to the data room or to get any more information about the company. The second thing is that they didn't have enough information when the round was closing and when we could get into the secondaries and purchase. But even though before the round closed, before the rover, they would promise us a discount and we negotiate with the sellers, but just that then the sellers and the board didn't have a clue. So in all those circumstances, when it's time to buy, we'll read the rover, or the price was different, and we never had access to the due diligence. So how do you proceed with those 3 problems? When can you have access to information? And then the other situation was, he's not around, and one of the founders wants to sell, and then you call the CFO, it's like, I'm too busy, we don't have a data room for you, no information, you have to buy based on whatever. So those are the 2 situations that we face. How can you help?
So let me tell you, first of all, I hear these horror stories over and over and over again. On behalf of the venture secondaries industry, I'm sorry, because it's unfortunately populated by some less than ethical actors. And there's people that claim things that actually don't have things, and people that claim to have information that don't actually have information. That is not our business. Our firm was founded over a decade ago. Our team is sourced from ex-BlackRock executives, including the former global head of equities at BlackRock, venture fund partners. Our chairman was the former CEO of the New York Stock Exchange. And what we built our business on is company-supported transactions selling these opportunities into the institutional investor market. And if you're selling to BlackRock or Fidelity or T. Rowe Price, then they need good quality information to do their underwriting on. And so with our main business model being working with company-supported transactions, we always have a data room, 100% of the time. And so what we have now from a fund perspective is access to a decade's worth of information from all of these transactions that we've worked on through the broker. So we are a step forward from pretty much 90% of the market based on that feature alone. The other thing that we have, which is very interesting and very differentiated, is we have the print of the market. So we know for most stocks in the market where that particular company has, the market is cleared for that particular stock over time at what volume. And so when we're doing our purchasing decisions, we can do better underwriting. And we can also say, what's the true market value, to your question, of that particular asset as opposed to a theoretical desktop modeling exercise. So it's something that we've been able to really use to our advantage in this market, where there are very few bidders for any given asset. And we can be smart about that asset and then undercut the market. So we think that we have a better mousetrap when it comes to trying to navigate opportunities in this market.
And what are the spreads right now
What do you mean by spread?
on the bid ask?
There's the bid ask, you can have a 30% plus minus 30%. And a lot of the work that the broker does is then bringing people closer. But what you're having right now is there's a total imbalance in this market where you have so many more sellers than there are buyers. And so if you're a buyer in this market that has information to navigate to good opportunities, price them at the right levels, you can kind of name your terms. And so what we've been able to do consistently in this market is undercut where secondary is clearing by between 20 and 30%.
So I have more questions. So there's a duration aspect to this, right? A lot of times employees, they have a timeline. They don't want to be in a venture for more than 4 years or 3 years, right? So they're like, I've been at this venture 3 years. Somebody says we're not going to get any, we're not going to cash out for another 3 more years. I'm past my deadline. I got to get out, and they want to sell to guys like you or use your platform, right?
Yeah. So the motivations for sellers for those individuals, it's almost always one of 3 things. I'm building or I'm buying a house, I'm getting a divorce, or I'm paying my taxes. Sometimes it's I've got to pay for the kids going to college. And so if you were getting your IPO coming in 2022, no problem. You got the money. No one got their IPO in 2022. So you've got a whole bunch of extra sellers that are trying to solve for these short-term duration point that you're making here is asset liability mismatch. Shareholders that have the balance sheet and the scale are riding it out. There's a lot of people that need some cash today.
And then the second observation I want to make is that brokers have a tremendous amount of information. So you should always ask people for greater insight than they're giving you, because they always have more information than they provide to you. So I'll give a great example. Last June, a broker called me up and said, I got XYZ number of deals, a lot of crypto, blah, 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 right? So I was like saying, who's buying all those cryptos? FTX is buying all those cryptos. So can I get FTX on secondary markets? And he says, hold on a minute. Comes back to me 2 minutes later. You can get FTX at a 50% discount if you buy 10 million or more. And I said, that's really interesting, because how are they buying everybody else if they're going at a discount? Right? So I'm just saying, I mean, so you get tremendous insights as a general investor, looking at the marketplace, seeing who's on the secondaries.
So I'd like to switch over and give Ricky a chance. So we were discussing the work that you're doing in the Middle East and the work that you're doing domestically here. And what is the difference of types of investments that you see interest in the VC market here domestically compared to the Middle East?
So I think there's the domestic consumption market that building a product that works for that region, and a lot of innovation comes in the US and the Western world, and then some of the emerging economies that they'll have, say, their version of their version of DoorDash. So that may work for some micro level, but what we're more interested in is something that's innovation that's scalable worldwide. So if you're building, say, some cutting edge cloud computing or something that's say image data detection. So some of those things, it's scalable across different markets. So things like that if you start with your home market, it works, then will help bring that and introduce that to another market. But it's hard for a founder to get into another market, another side of the world, different culture, different languages without understanding the market. So we have to find them the right partners, right advisors, and help them understand the market and gradually get it.
And how do you get the buyers and the sellers together? It's
Through meetings like this.
Meetings like this and
Dr.
trust.
Grossman just spoke to the whole family office, and it's just kind of connecting people and so on. You know, we do a lot of work with universities, and universities are mostly pre-revenue. So we host these kind of meetings with universities. There's a group called Autumn, that's Association University Technology Transfer Group, and universities are really in this country a hotbed for innovation that do the spin outs from universities, whether it's Stanford. We just met with folks. We opened up an office in Salt Lake City, our 22nd office. So we met with folks at the University of Utah. There's some major family offices that contribute to the universities. They want to build new buildings and so on, but they also want to build into their innovation, into their doctors and science programs. So they have spin outs to better the world. So family offices are very active in that area as well.
and you see the same thing, Ricky?
Yes, we see, so in the US, the universities are, a lot of them funded by endowments, but if you look at some, especially in the Middle East, that the sovereigns are just funding the universities. So I was also in Dubai. I think they pronounce it Qatar.
Yeah.
So they have so Carnegie Mellon University that I graduated from also has a campus there, and as well as some other universities that I spoke with the dean. They don't have to raise money at all because the Qatari government is just funding the whole thing.
Yeah.
So they take the fundraising side out of the equations, like how do we produce the talent, do research, and just keep driving it.
Yeah, one of my biggest clients years ago when I was at my former firm was Saudi Aramco, and it was just as far as they had just so much cash, and they brought everything in because they needed so much infrastructure and so on.
And they have incentives to attract R&D talent from outside the region to move there, to subsidize the salaries and living expenses and taxes and that.
Related to that, Ricky, I'm just wondering, given that you're operating in markets where the wage rates are often so much lower than what they would be here, how much of a labor arbitrage opportunity do you see, maybe to develop products for this market in a place where engineers are a quarter the cost? Is that part of your thinking at all, or not?
So I think it depends on, so there's the cutting edge R&D. So I think that you need to get the very top tier. And then there's the parts of building a product. So building a product, you need qualified engineers, but you don't need a rocket scientist to do it. So I think that's when you can get some of these cost of labor arbitrage by doing it some less expensive markets. But when you're talking about top tier R&D talent, then I think every market is competing for those researchers. But in some of those countries that there's so not just from a cost, but maybe even more favorable visa policies or things that can attract people that may not be as easy for them to come to the US.
Just one more just general point. I don't know if everyone noticed this, and I'll let Mark jump in, but Warren Buffett just sold, I think, 90% of his holdings in Taiwan Semiconductor Company, a friend of mine. He used to be the chief IP counsel there, and obviously that was the #1 chip manufacturer around the world. So there's a lot of geopolitical issues with that everyone knows about between China and Taiwan. But I'd continue, even going back years ago when we first had these meetings, there was a lot of talk about investment come from China into China. That is not happening. I don't know what you call that, John. It's not crypto, but China is a no-go. And,
They're good at making balloons.
yeah, they're good at making balloons, and that's that's actually a scary thing. Yeah.
In the back?
My question was, obviously, you talk about the margin and liquidity. A lot of times that tends to attract other players, other capital. What kind of capital inflows you see from like competition or bigger shops or things like that in secondary space?
So in the institutional market, which is where we're playing, there's mainly three main categories of investors, which are number one, the big asset managers, BlackRock, Fidelity, T. Rowe, and the like, hedge funds, and then venture funds. So, asset managers, I think you can understand what they're up to. The hedge funds were taking portfolios with strategies where they had 95% of the portfolio in public markets positions, and then taking 5 or 10% in pre-IPO positions that were actually delivering 70% of the returns of some of those strategies. Now, in this last year, because of what's gone on in public markets, and because actually a lot of these hedge funds are themselves facing redemptions, with less liquidity, they're now actually net sellers into the secondary market. So they went from 25–30% of the buyer market to less than zero over the course of the last 12 months. Venture funds, late stage venture funds, some of the big names that people will recognize, what they would normally do is take advantage of discounted buying opportunities in secondary, that 10 or 15% discount, and stock up on the top 3, 4, 5 portfolio companies that are driving the return of the fund. What's happened in the last year is crazy upside down world, and because it got too big, the venture funds don't want to take up, because actually what they'll have then is a valuation policy mark to market problem. And they don't want to have to explain to their LPs why their number one best performing portfolio company just got marked down by 70%, which is crazy because that's probably in the best interest of their investor to take some more of that share at a substantial discount. And so what that leaves for us is we're almost last man standing effect. We've got a fresh pool of capital, no legacy positions, very well informed and equipped with data so that we can now go out, cherry pick the best performing companies in the market and close on these acquisitions of this stock we just closed one a couple weeks ago, a 64% discount to last round valuation, less than 4 times next 12 months sales on a company that's already producing over $200 million of revenue, is already cash flow positive, highly performing business that's probably going to exit early on when the IPO window reopens.
So Mark, how much competition, if any, are you seeing from firms that are not actually doing secondary transactions, but loaning money to founders, taking the stock as collateral, and thus not creating a taxable event for the founder?
It's a really interesting space. And I think that a lot of those sellers or people in need of liquidity would love to be able to pledge their stock. The problem is that for those lenders, you have an almost illiquid asset. And so they're giving a 90% haircut on the value of that. And the average cost of capital that people can get in those loans against private market stock programs are like 30% IRR cost of capital. And so some people do it, but some people say, actually, that sounds all expensive and a little complicated. I'll just sell a couple $1 million outright and get the deal done that way. So there's a market there, but it's very expensive capital.
And Ricky, what do you see? What do you forecast for investments in this down market going down the next 12 to 18 months? And that's actually for all three of us.
I think it's a buyer's market. And historically, every time there's a downturn, you look at the great venture crisis, venture funds that started in those years do exceptionally well. And institutional investors, they know that, they realize that. So even they say they're over allocated, but they'll still try to find a reason get into new venture funds. So as family offices or as somebody who may not have such a systematic portfolio, but we still have that access to that same data. So I think now's the time to look at getting into the venture funds already.
Yeah,
About 5 minutes?
yeah, real quick, Marty, Dr. Benuti on the next panel said, if you just send them the link for the Zoom.
I'm gonna send it again.
Yeah, send it again.
Yeah, we spoke on the phone.
Yeah, great, thank you. I think with the family offices, I agree with Ricky. I think the valuations, as Mark mentioned before, have come down to a more reasonable number, and it's a buyer's market. And if the technology and the idea is good, whether it be AI or whether it be other basic consumer products, we still, I'm fortunate because we see the deal flow and we're handling the deal flow. So we're optimistic, but we hear from many it's a tough economy. On the fund side, we have groups that come to us that say, can you help? We're raising a $250 million fund. You may have seen even the actor Ashton Kutcher, who's active in the family office space, was very active in WeWork and other initiatives. Just announced that he's going to be asking for setting up a $200 million fund just for the AI space. So if the technology is there, the idea is there, I think the money will follow. But I still tell all the founders, you got to hustle, and sell.
Well, what we're seeing in terms of valuations and what our expectations are with regard to exit is, and I don't want to sound hyperbolic, but having done more of this for longer than pretty much anyone else, our firm, we're seeing once in a decade lowest historical low valuation multiples right now. If on companies that are highly performing, cash flow positive, self-sustaining businesses. So this is, from our perspective, if you could buy the public market in October of 2008, that's the opportunity that we're seeing right now in direct venture secondaries, to be able to cherry pick the best companies in the market and pay decade low entry valuations on that. With regard to exits and IPOs, Morgan Stanley is predicting that you're going to start to see exits around Q3, Q4 of this year. We think that could drag out until Q1 or Q2 of next year. Frankly, for us, that's great if it lasts a little longer because we can buy cheaply for longer. And we're looking to exit within before 2027. So we have a long runway for getting some good exit opportunities at reflated valuation multiples.
What sectors are you seeing the most activity in?
So we're being careful on some of the macro condition impaired categories. We're being careful on consumer. We're being careful on fintechs with residual credit exposure. The areas that we are maybe overweight on are enterprise software, recurring revenue model businesses, space technology. Not to make too much of a joke, is really exciting right now. There are absolutely generational companies that are being created right now as we speak in rockets, in the supply chain, in satellite technology, and they are just coming to this inflection point where they're producing cash flow positive business results. And you can buy into these companies at eye-poppingly low multiples right now.
There's a company, Relativity, that's they spoke in this office 3 or 4 years ago. They were valued at $400 million. I think they're valued at $4 billion now. They have high-level 3D advanced 3D technology that they're making rockets. And the idea is you have to bring the equipment to wherever they go, Mars or the moon or asteroids or whatever. But it's amazing technology. They're doing some great things.
We couldn't agree with you more. They're a portfolio company in our fund, and we actually have a co-invest opportunity on Relativity space right now. So if anyone's interested in that, please have a chat with them.
So is there much activity in the healthcare space?
Yes. In healthcare, we're excited about healthcare delivery services businesses, and also technology-enabled devices and other service providers that are really getting real commercial traction in the market. And that's what we're looking at. We're not trying to be so smart of picking the best technology. We're letting the market tell us what's actually being accepted and winning.
Just on that point, if I can give a plug to the next speaker, and Marty, Dr. Minuti said he's able to get on the phone, but not on the Zoom to see the picture. So
I told him this, exclusively what he has to do, but yeah.
yeah. So I'll give the plug to Dr. Minuti, but he's a gentleman in the healthcare space, the orthopedic surgeon. The products and the intellectual property is generated more than $5 billion for the company's licenses IP to. So there's always, I think the healthcare is what, 1/7 of our economy. There's a lot of different deals and stuff going on in that space.
So Ricky, I would just want to let you
Yeah.
finish off and give your summary.
Yes, no, I agree. I think from healthcare, I think anything with data and AI driven. So AI touches upon a lot of different industries that access to data that's available now that wasn't available a few years ago, and how we live our life today is a lot different from 2 years ago. So how future of work, I think that's education, those things, and then also from a lifestyle perspective, mental health, I think that's going to be huge. Travel and hospitality, that's going to come back as we were seeing revenge travel, but margins are going to be key. So companies have to innovate to get you involved. And finally, food security. That's something that it's even more of a necessity in some parts of the world that they realize that with the way that the world supply chain gets disrupted.
Okay.
Marty, I think that